what we are doing here in this paper is looking at or evaluating a particular loan waiver program from the state of Uttar Pradesh in India. The idea comes from the fact that, of course, in the case of rural households, debt plays a very important role in terms of their livelihood, and particularly for the easier access to credit. The loan given by various banks, the formal sector, has increased dramatically over the years since 1981. And again, to increase for easier access to credit and for easier livelihood, one of the most recent political policies has been the debt waiver programs, both at the national and state levels. So what we do in this paper is basically try to understand the effectiveness of debt waiver programs, particularly the UP debt waiver program, which was called the UP Rin Maafi Yojana in 2012. And we look at specifically consumption decisions of households and the productivity of these agricultural households. So of course, there is there are of course political reasons for implementation of debt waiver programs, but political reasons aside, there are also very important economic motives that are put forward, particularly in the macro literature, the macroeconomic context, in favor of debt waivers. So the prominent theory in this case is the debt Laffer curve, is the idea of the debt Laffer curve, that if the debt amount is just too high for countries to, so this is in the context of countries, international debt. So if the debt amount is just too high, the outstanding debt, then there is a drop in repayment because countries are unable to repay that kind of debt. So in this context, if the idea of optimal debt is that if you waive a certain amount of the debt, then the country comes back in a position to put some effort in producing as much output as can be used to repay the remaining debt. So the same idea can actually be taken to households, to micro households or farmers, let's say to agricultural households, to say that look, these households have very high debt levels, they are not able to produce enough agricultural output to be able to repay that debt. So why don't you take out or just waive part of it, so they are back in the mode where they can increase agricultural productivity with this waived debt, and hence going forward they can take more loans and repay debts. So that is the positive theory behind it, but what does evidence suggest? So I'll just, because particularly this paper is related to the micro context, so I just have in over here the micro evidence from India. So there are 3-4 papers now which look at the national debt waiver scheme and try to find out. So the national debt waiver scheme essentially was done in a way that people were given debt waiver depending on the land size. So there was a cut-off land size below which people were given debt waiver. So because of that discontinuity in land sizes, some papers have used regression discontinuity models. Others have used difference in differences to find out whether this particular national level debt waiver scheme had any impact on productivity and repayment rates. So using various data sets, nobody finds any improvement in productivity or any improvement in repayment rates due to the waiver program. So what we do is try to motivate the idea that why a debt waiver program might have no effect on productivity, or could essentially have some effects on, let's say, consumption decision of households and investment decisions particularly. So what we try to, so I'll just give you again the intuition like the previous talk. So what we try to do is we have a 2-period model of household decision making, utility maximization, where people make consumption and investment decisions over the 2 periods. So in the first period, they make consumption and investment decision, and the second period, they just consume whatever they produce. And some of the assumptions in this model is that people do not have any initial endowment. So the only endowment that they have is land, which is used as a collateral to borrow. So this is just simplification. And so they borrow in period 1 and decides how much to consume and how much to invest. So that's where the trade-off comes in, and they maximize consumption. But this is actually a very important assumption in the model, which so that the households have to ensure that the land is not confiscated in period 2, so if they are able to repay the debt. So investment in period 1 generates income used for consumption and loan repayment in period 2. So which means that if the household invests more in period 1, consumption in period 1 has to fall. That's the trade-off. And then investment is risky, and the probability of success depends on the amount of investment. So basically what we are saying over here is that if you invest more, you are able to produce more, and the probability that you are able to repay your debt increases, right? So the probability of success that way depends on the amount of investment directly, and the household incorporates this probability. So this probability ultimately also determines the probability of confiscation, of course, because if you are not able to repay, then there, with some probability, the institution, the formal institution will also confiscate your land, the collateral, and the household incorporates this probability of confiscation in their maximization problem. And how the loan waivers come in is basically by changing this possibility of confiscation. So the repeated loan waivers create expectations of weak contract enforcement amongst households, so that collaterals are not seized in case of default, leading to lower investment and higher consumption.
What do you mean by weak contract enforcement? If the loan is waived, then it's not weak contract enforcement, it's that somebody is paying the loan.
Right. So basically your collateral is not seized. So that is how it comes in.
I'm just objecting to the phrase weak contract enforcement.
Yeah. So basically what we are saying is that if you have repeated loan waivers, then suppose in the next period I expect a loan waiver, so which means that I expect that my collateral is not going to be seized. So the probability of confiscation actually falls in my utility function. So that's where the contract enforcement comes in. Okay. So so essentially what we are, so effectively what the model says is that when there are loan waiver programs, repeated loan waiver programs particularly, it reduces this probability of confiscation which the household incorporates within their utility maximization problem, and increases consumption in period 1 and reduces investment. So what we are looking at is the UP government loan waiver program, which was announced in November 2011. The eligibility formula over here, which is very important for an analysis, is that farmers who had taken a loan up to 50,000 from the particular bank, the cooperative bank, and had repaid at least 10% of the loan amount that was due, these are people who are eligible for loan waivers. Okay, so this is unlike the national program, which has a cutoff on the basis of the land value. And this program was rolled over 3 years. So because of the staggered implementation, again, we can employ a difference in difference model. And so across UP, I'll just show you, all the districts of UP were actually covered across these phases, except for one particular district at the time of our survey, which was yet to be covered by the program. So that was Lakhimpur. So this is the timeline of the program. So in 2009-10, there was nothing, and the program announcement came in somewhere over here, somewhere here. And what you see is before the announcement, the repayment rates were as high as 40 to 50%, and then after it was announced, the repayment rates fell considerably and then rose again. So what you see over here is district-wise, the average repayment rates of loans across UP. This is 2010-11, before the loan waiver was announced, and this is after the loan waiver was announced, so reflecting much lower repayment rates across UP than before the waiver was announced. So of course, one of the reasons is that because the loan waiver was announced, so many people would be eligible for loan waiver and hence they don't need to repay. But recall that the calculation whether I am eligible for the loan waiver itself is quite complicated, because you have to make the calculation going backwards that how much have I returned and whether I am eligible or not. So we believe that this is possibly not entirely driven by a strict calculation. So what we do is we essentially go and collect primary data, because there was no data set to evaluate this, across 770 households in 6 districts of UP. The way these 6 districts we chose was to keep Lakhimpur the only district where the program was not rolled out as the pure control district, and then also have a couple of districts from the other regions which fell in each of these phases of the program rollout. Now, there are 3 types of waiver status. Of course, whether you actually receive waiver or not, but the main calculation again comes from the eligibility status, which is sort of what we say is potentially exogenous. And effectively, what we are doing over here is comparing households that received loan waiver or did not receive loan waiver, but in terms of eligibility status, whether they were potentially supposed to receive the loan waiver and potentially not. Just a brief overview of what we actually find in the paper is summarized over here. The evidence that the farmers who received, or households that received loan waiver, actually had lower income than households that did not receive the waiver. However, because of the waiver, their consumption was higher compared to households that did not receive the waiver. And this we find both for consumption overall as well as for very specific type of consumption, which is social spending, which essentially wedding and other types of social spending that they do. So the main model, I'll just skip these in the interest of time, and the main model essentially rests on a difference in difference idea. This is not over time, so this is not the typical difference in difference that you see, but what we are doing is we are comparing the eligible and the non-eligible households in the districts that received the waiver, and then comparing that difference to, again, the same difference in the district that did not receive the waiver. So effectively cancelling out all kinds of characteristics that are different between the eligible and non-eligible groups. And after doing that, what we find is consumption increases, social spending increases. We do not find any significant impact on productivity, although the sign is negative, implying that, loosely speaking, this implies that farmers that received loan waiver had a higher consumption but lower productivity. We also do matching, so essentially we match households in the eligible and non-eligible groups, and then do DID on the matched sample. Of course, the sample size falls dramatically from the already small size, and again we find a similar story over here, that there is no impact on productivity but a positive increase in consumption and social spending for those who receive the loan waiver. So just an aside, I mean, this is an interesting piece of evidence, and since I have not been asked to stop, so in the district of Lakhimpur, in the district of Lakhimpur, which, remember, was the district which did not get the loan waiver at the time of our primary survey, people were asked that what fraction of loan did you repay from in terms of the formal loans taken from formal sources as opposed to money lenders, so informal sources. And we still find that this particular district, where people still have not or are expecting the loan waiver still, they have returned very small amount, compared to informal, they have returned a much smaller fraction of formal loans compared to informal loans, because informal loans do not come under the purview of the loan waiver. So it's only the formal loans that essentially are eligible for the waiver program. So yeah, so that's it. I'll end there. Thank you very much.
Okay, thank you for a very nice presentation, and thank you, Susan, for asking me to become a discussant for this paper, which I really enjoyed reading. And this is an extremely topical paper. You know, every central banker has warned the government against going in for loan waivers, and every government has shown central bankers their thumb and gone ahead with it in any case. Okay, now there is really a need to understand what the hell is happening in this field, because as I love to say, we economists are always full of ourselves and we keep convincing ourselves that we are right, okay, and keep complaining that politicians are really without any imagination, okay, and keep doing the wrong things, okay. Now, therefore, it's really important that we understand what is happening because of these loan waivers. Now, the aim of this paper is to estimate the efficacy and sustainability of the popular loan waiver programs in achieving their announced targets. Now, over here I have a small objection. What is not made adequately clear is how the words efficacy and sustainability are to be interpreted. Okay, what is it exactly that we mean by this? Are we just evaluating this? And if we use the word efficacy, then it has a particular meaning in our subject. Even that meaning differs in different contexts. Okay, so we need to be a little careful as to how we use the words efficacy and sustainability, right? Sustainability, whose sustainability? Can governments keep doing this again and again? The answer to that is possibly yes. Will farmers continuously accept this as a good thing? If I was a farmer, I would be dashed happy to receive this. Okay, so sustainability in terms of what? Are you talking about the credit market? That the entire atmosphere in the credit market is going to be really vitiated and you're going to see less people willing to repay loans. So when these two words are used, a little more clarity on what exactly we are referring to. And when I read the paper, at least it was not clear to me what was being thought of. Now, study the loan waiver program in Uttar Pradesh, which was announced in 2011. I think it's a neat theoretical model with a very clear and sharp prediction that you come up with. It is argued that as the probability of enforcement of the contract increases, that is the level of expected penalty, consumption would be discouraged and investment would be encouraged. So that is the kind of setup that you have. Okay. Now, so then authors use state level data and data based on a primary survey to make the following assertions. First, is there a drastic fall in repayment rates? Okay. And loan waivers lead to higher consumption and social spending and lower productivity. And these findings are then further counter-checked by using difference in difference analyses and some robustness checks, where the most of the conclusions are actually going through, except productivity, I think, with a little bit of a. So this is how your whole setup is. Now, when I intend to evaluate this piece of work, I tried to figure out is in what way do these results add to our understanding of the phenomenon in question. So to figure that out, I need to figure out what has already been done, right? So what do we already know? Now, very quickly, I compared the three studies that you quote with your study. So in 2012, it was based on a sample of 2,897 debt relief beneficiaries in Gujarat. So a state level study had already been done with possibly a larger sample size. So they find that approximately 1 year after the debt relief program, households that received full debt relief remained significantly less indebted than households that were eligible for partial debt relief. So this is the first thing that they find in Gujarat. They also find that debt relief increased the dependence on informal credit and reduced investment, prompted by a decline in productivity. So they do this with the control group and all the standard stories that were. So the recipients of an unconditional debt relief are significantly concerned about their future access to institutional credit and exhibit investment behavior consistent with future credit constraints, right? So this we already know from another state. Of course, that was a different debt relief program. The nature of that debt relief program was slightly different, but this we already know. So then this I found was the study which I really liked. That so you use data which is slightly different. You use panels on districts, okay, and you have 489 districts, and you have a panel on the districts between 2001 and 2012. The debt waiver happens in 2008, so it really sets up a very, very nice way to figure out what's happening. So they find a significant reallocation of bank lending away from districts with greater bailout exposure, right? So it is very clear, therefore, at the national level, what is happening. So if there is a district level bailout, in the next period, you find that banks are not going there at all. Okay, so this again has been observed at the national level with a sample of 489 districts. Okay. There is a sharp increase in defaults concentrated among borrowers who were not in default when the program came into effect. Okay. No effect on productivity, real wages, and real per capita consumption. So here, there is a distinct difference on what you find on consumption and what these people find on consumption. Okay, yeah. And the last paper used data on 12,645 farmers who received a crop loan, and these are complete transaction records from banks, from a particular bank over the period October 2005 to May 2012. Now, so they find that the number of days taken to repay debt increases for all borrowers following a waiver. Rationally predicting adverse borrower behavior, lending institutions, they are generating ex ante inefficiency, and access to finance for poor households declines following unconditional debt waivers, right? They point out that relief at the time of droughts may lead to some real benefits, and that's why I think you try and do something with droughts in towards the end of your paper. Okay, so now, so comparing the size of the data sets used in the earlier studies and their conclusions with the you ask yourself, what are the new conclusions that I am offering? Of course, I grant that the nature of this debt waiver is different. The nature of the debt waiver that happened in 2008 was different. But I'm not enlightened on what happened then and what happened now. Are they different? So this is one thing possibly that you could look at. Okay. Apart from what has been said about social spending, nothing much seems to be new, though you have some contradicting results on consumption, right? So, of course, the conclusion on consumption is very different from the earlier study. We are not told anything about what drives this difference. It's very clear that, consumption is a key variable, right? So if one study is telling me exactly the opposite is happening and, your is at a little variance, then you need to enlighten me as to, why is this difference there in these two? Is it the design of the debt waiver? Is it the time, or what is driving this result? Okay. Given the smaller sample, more could have been done to focus on further analysis on cross-sectional differences. I think land holding is something that possibly needs more articulation. Now, for example, if information of land holding were available, then a comparison over farm size would have been interesting, because that is something that people have not done in a very big way before, and you could bring that on the table. Okay. Now, this is an objection that I have, that one of the control variables used is the interest rate charged on the loan. If these loans fall under priority sector lending, then these rates should be more or less same across farmers, right? So how the hell does that become a control variable then? What will be different in the loan contract is some other parts of the contract would be different. But the rate of interest itself, I don't know whether it will be different. These are priority sector loans. By law, they have to be identical. Okay, so I'll stop here. And
Thanks, Rajendra. Who else in the room has interesting comments and differences? I see Sanjay Arte is here. Sanjay, do you have insights on loan waivers for us? Vikas, you want to say something? Vimal, Renuka. Okay, Vikas, please start. Use the mic.
So I had just one question related to the eligible versus non-eligible, because that's, I think, the setting that you're using. I didn't get a good sense of how this potentially could affect your results. So in the sense that who is eligible, who is not eligible, if that's correlated with what you actually find. So there's a heterogeneity there, right? How do you take care of that?
So, just 2 points. One, I looked at the total effect size on consumption and on social spending. The fraction of social spending is not that large compared to the effect size on consumption. So, one of the stories that sort of play out in my mind is households do reach their budget constraint in some sense, and when you actually have these debt waivers, their utility from consumption is not just necessarily wasteful expenditure, but they actually manage to consume what they would have to. So there might be a positive. I mean, I don't see increase in consumption as necessarily something bad because there was a debt waiver. So that's one. The second is I'm not very sure what the cost for banks in lending in the system is. In other words, when there is a farm waiver, I've been always confused with the other set of papers about why is it that the banks will not go back to lend in these districts, because effectively it's free money for them. I mean, the state is going to anyway waive this and give the money back to them. So what is the cost to the bank in actually lending to these guys? So I don't know, because I would have thought there is moral hazard in both households and for banks. So that's it.
Vimal, can I come back into this? There's a CAG report on the implementation of these debt waiver programs, which helps you to understand that the actual translation of the political announcement into the payments to the banks is a complete mess. Just talk with me separately. I'll point
Actually,
you to
that report.
You wrote about it? Okay.
Actually, that report also talks about how households don't get the money. So it's not just about the banks, actually.
Tanika, do you want to respond to all these comments?
Actually, I have one more comment, one question. You do have information on loans taken from other sources as well, right? And one of the things that we have been hearing, and maybe you can't answer this, but one of the things that we've been hearing after the recent spate of loan waivers is that there is a contagion effect on other lenders. Right? So while the bank has given the loan waiver is on bank loans, but people stop repaying other lenders like microfinance institutions. And do you have any evidence of that in your data set?
Yeah, I have some time. So I'll just start with yours because I remember that the most. So that's the evidence I showed in the very last slide. So what we find is they actually tend to return the informal loans. I cannot distinguish between microfinance institutions and others over here. So these are primarily moneylenders, relatives, etc. Someone from the village. So they tend to return those loans at a much higher rate than the formal loans.
But was that different before the loan waiver?
I am not able to see
because
that.
It's
remember?
optimal for households, right?
Yeah, so
to pay off the...
I don't have a panel, I have a cross section, so I cannot see that. All I can say is we have a second paper looking at secondary data where we find very similar evidence over time.
Okay.
Actually, in the fintech lending, people have shown this in the US also, that if once you have access to fintech lending, you actually pay off your credit card debt, etc. So you actually reduce your... So you pay off your high interest.
Only to actually borrow again.
Yes.
Correct.
So
Yes.
Exactly.
Yes, yes.
So very similar.
But yeah, but it's a similar. It just reminded me of that. So.
Yeah. So in terms of social spending, coming back to your question, Vimal, as per This is already on.
Yeah, just close
Okay.
up.
So, yeah, coming back to your question on social spending, so consumption, increase in consumption is not necessarily bad. Remember the idea, so this is also related to that, what is the target of the policy. So what I understood from the policy documentation was one of the targets was to increase investment and productivity in agriculture. So, so consumption, definitely the idea was that over time consumption would increase because productivity has gone up, etc. But immediately what we see over here is consumption has gone up because of the waiver and not through the productivity channel itself. But more importantly, essentially the same thought that consumption itself is not bad, so because of which we went on to the social spending, which is of course unproductive. So these are essentially events in the household, and we find even if it's a small, if it's not a very small fraction, I cannot tell you the exact number now, but in IHDS secondary data, it still forms about 20% of household consumption, wedding spending, etc. So that sense, it's not very small, and that's what we think is not a very productive spending. Coming back to your question on eligibility as an endogenous variable, yes, absolutely, and that's the whole idea of the difference in difference. So in difference in difference, because we are comparing eligible and not eligible households, so essentially what it means is we are controlling for eligibility status. So it takes away everything that varies between two households because of the eligibility status. Because we have the control district of Lakhimpur where no one was treated. But we are...
What you need to then do is, you need to model the eligibility itself, and you need to do some matching.
That's exactly what, exactly.
That's what you did?
Yeah.
Okay,
So
I didn't quite
I
get
was just
that.
coming to, so that was the last slide I showed you. Yeah, I matched between eligible and not eligible
Yeah,
households.
yeah.
So that's
fine.
how we take
Okay,
care.
that's fine.
So now coming back to the main chunk, many thanks for your all the comments, and particularly your very detailed discussion of the paper. So I agree that the words used have not been particularly right. So that's an easier problem for me to solve possibly. But the idea of efficacy, but we used it in the with the thought in mind that efficiency, the idea of the loan waiver is to increase efficiency in production. So to basically understand that efficiency in production, we are using the word efficacy. But of course, I can think of better word than sustainability. Now, in terms of how our paper is different from the previous 3 papers that you have cited, and I have referred to in the paper. So all of these papers, even Khan's in the Gujarat case, actually uses the National Debt Waiver Program. Right? So even when they're looking at a specific state, it is the National Debt Waiver Scheme that they're looking at, which of course, as I said, it had a land cutoff, so it becomes very correlated with other wealth of the household, income of the household. So it in all these papers that has been a major difficulty to identify whether the difference is coming because of wealth differences or whether the difference is coming because of eligibility of loan waiver. So that was one. The other reason why we thought that this is different is, and also relates to your question on why the impact on consumption, which was not there in the previous papers. The reason we thought is that, so that was the whole motive behind, or the encouragement to write this particular theory, is that 2008 was really the first big debt waiver that led people to expect future debt waivers. So because of this expectation of future debt waivers, this is how we motivate the theoretical model also. Because of expected debt waivers in the future, the consumption spending increases. So that the weak contract enforcement part, which is not there possibly in 2008 when it was done for the first. I mean, of course, there had been other debt waiver programs in the past also, but 2008 was really the very first big debt waiver program in recent history. So, so this expectation change, we thought, came with the 2008 debt waiver. And land holding, yes, that's a very good point. In fact, we are thinking, we have been working on it lately. And one idea was to find out whether it varies by land holding, and to also see whether how important is land for livelihood. So there are many households which are actually now quitting agriculture, moving to industry, with higher education, etc. So we wanted to see whether the response is actually different for those households compared to other households for whom land is very important to retain the land for future agricultural purposes. So we are looking into that. And interest rate here is essentially the average interest rate that they pay across all the loans that they have taken, not specifically the waived loans. So it also includes informal interest rates. Yeah. But I think we are robust to inclusion of and non-inclusion of the interest rate.
Rajendra,
Yeah.
can you finish with her over the chai? We're running out of time.
Yeah.